for today's webinar, Leveraging the Benefits of Using Charitable Remainder and Lead Trusts. My name is Danette Scheip, and I will be your moderator for this webinar. I'd like to go through a couple of housekeeping items before we get started with our speakers. First, we encourage you to ask questions throughout the presentation. You'll see a webinar pane that you can use to enter your questions. Just click the red button to send the question to our presenters. They will answer the questions as time allows at the end of the presentation. Secondly, we want to make sure that you have excellent audio quality, so please select the appropriate setting. If you are using a telephone, please click on the Use Telephone Audio mode, or if you're listening through your computer, then please click on the Use Mic and Speakers option. Let's review the requirements for those of you who are interested in CE for your participation in this webinar. Use a personal computer, no PDAs, and log in with your own information and unique URL. Be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. Actively respond to at least 75% of the polling questions. And finally, complete the evaluation survey at the end of the webinar. Now let's meet our presenters. Lynn Henley is a tax partner at Armanino. During her 17 years of experience in public accounting, Lynn has provided consulting and compliance services to a variety of tax-exempt organizations, including public charities, private foundations, supporting organizations, social welfare organizations, labor unions, social clubs, and business leagues. Thanks for joining us today, Lynn. We will also be hearing from Monica Peltz. Monica is a partner in the audit department and has been assisting nonprofit organizations with their accounting and compliance needs for over 15 years. Now let's review our agenda and learning objectives for this webinar. The topics we will cover today are Charitable Remainder Trusts, Charitable Lead Trusts, CRTs, types and FMV measurement, accounting for Charitable Remainder Trusts. During today's webinar, participants will identify donors with planned giving potential, determine some of the tax consequences of contributing to a CRT and a CLAT, applying the appropriate valuation of these assets in their financial statements, and comply with the financial statement disclosure requirements related to charitable contributions. Now I'd like to turn it over to Lynn.
Thank you, Danette, and thank you to everyone who is joining us for today's webinar. Charities need funds for daily operating expenses, but they also need future sources of revenue. Deferred gifts, also known as planned gifts, provide the organization with an identified specific source of future revenue. The strategies known as planned gifts are a variety of charitable giving strategies that allow donors to give to charity in ways that work for the donors. Today we will discuss two of these strategies, Charitable Remainder Trusts, referred to as CRTs, and Charitable Lead Annuity Trusts, referred to as CLATs for short. Let's begin with Charitable Remainder Trusts. Our first consideration is how can we best address whatever needs our potential donor has. Although a Charitable Remainder Trust may be beneficial to a donor under a number of different scenarios, CRTs are most powerful when established for a donor who has high value, low basis stock, meaning that they didn't pay very much for it, but now it's worth a lot, and that he or she has held for more than a year. So if you consider your donor who has a portfolio which consists of a large percentage of one particular stock, that donor may at some point want to diversify those holdings to protect him from the risk of holding too much of a concentrated position. He or she also may not be getting income off of that stock, particularly if it's closely held, and he or she may want to provide a more secure